Imagine stepping into a casino, sitting at a high-stakes table, and making 100 incredibly terrible financial decisions in a row.
Yeah, that sounds like a fairly standard Saturday night for most gamblers.
Right. Every single bet is just an absolute loser. But imagine standing up from that table, checking your wallet, and realizing you actually still have over a third of your money left.
Which is wild to even think about.
Exactly. Like more than enough to come back the next day completely unfazed and just keep playing. In the financial markets, I mean, that is not a fantasy. It's actually a mathematical certainty, provided you have the right statistical shield. Welcome to the Franks Report. I'm Jessica, and I'll be guiding our journey through some truly fascinating territory today.
And I'm Philip. It is really great to be here with you all, ready to unpack the essential mechanisms that keep professionals alive in this business.
For sure. But before we jump into the actual mechanics, just a quick reminder to follow the show on your favorite app so you never miss a deep dive. And, if you find yourself captivated by the strategies we're pulling from today's source text, you absolutely need to pick up a copy of our book, The Funded Micro, Modern Future Strategies for the Prop Firm Era.
Yeah, we essentially take all of these concepts and expand on them beautifully for the current market environment. It's really a must-read if you're taking this seriously.
Definitely. Also, we want to send a huge thank you to today's sponsor, TradingView. They're honestly the fastest, most intuitive way to follow markets.
Oh, absolutely. If you're charting your trades, you need the right tools. Just use the referral code in the description, and you can save $15 on their business standard tier.
Love it. So let's get into the actual mission of today's deep dive. We've got this massive stack of research and incredibly detailed notes outlining how professional market mechanics and risk management actually function.
Right. And we are moving way past the baseline stuff here. You already know what a stock is or what a futures contract is.
Yeah, exactly. Today, our goal is to completely demystify the sort of invisible mathematical rules that separate the pros who actually survive from the amateurs who just, go up their accounts.
And the primary focus of our source material today, it actually shifts the entire paradigm of what trading actually is. Because the foundation of professional trading, it isn't about making money at all.
Wait, really? Yeah. Because that feels like the entire point of trading.
You'd think so, right?
Yeah.
But no, it is entirely about capital preservation. Without a very strict mathematical framework to protect your equity, the natural volatility of literally any financial market will eventually deplete your account.
It's just a matter of time.
Exactly. It doesn't even matter how accurate a given trading strategy might be in a vacuum. Because if you cannot preserve your working capital, you just can't survive long enough for your edge to play out.
The text frames this in a way that feels almost blindingly obvious once you hear it, but people ignore it constantly. Let's think of trading capital like the physical inventory of a retail store.
Oh, I like that.
Yeah, so imagine you own a high-end shoe store. Your entire business model relies on having shoes on the shelves for customers to actually buy. If you run out of shoes and you don't have the cash reserves to buy more inventory from your supplier, your business instantly ceases to exist.
Oh, it's just over.
Right. You could have the most beautiful storefront in the city, like an incredible marketing team, customers lined up around the block. But without inventory, you are done. In the markets, your cash is your inventory.
Yeah.
If you run out of capital, your trading business is over.
That retail analogy is perfect because it really captures the gravity of the situation. Professional risk management is entirely defensive. It focuses on limiting the impact of any single losing trade.
Like any single bad inventory purchase.
Precisely. It limits that damage so that the doors of your shoe store simply stay open for the next opportunity. And the core mechanism our text introduces to guarantee this survival is known as the 1% rule.
Okay, so I want to push back on this a little bit because applying a strict 1% rule, it feels almost impossibly small when you're actually sitting at the screens.
It does feel very tight.
Yeah, I mean, the rule dictates that you never risk more than 1% of your total account equity on a single trade. So if I have a $10,000 account, you're telling me my absolute maximum allowable loss for any single position is $100.
Just $100.
How does anyone actually build wealth or make a living doing that? It sounds like playing with pennies.
I get that it does feel restrictive at first glance, especially in a culture that, glorifies massive leveraged wins on social media. But looking at it as just $100 completely misses the structural architecture of what that limitation is actually doing.
Okay, how so?
Well, capping your maximum risk at 1% creates this massive, nearly impenetrable statistical buffer. Think about the pure mathematics of that limit. Assuming the dollar amount scales down as your account drops, it would require dozens, like approaching 100 consecutive losing trades to completely liquidate your account.
Wow. 100 consecutive losses. I mean, you would have to be actively trying to lose money to hit a streak like that.
You really would. It is a statistical rarity for any disciplined trader. Now, the market will absolutely hand you losing streaks. A string of 5, 7, or even 10 losses is an inevitable part of all trading systems, no matter how refined they are.
Right. Nobody has a 100% win rate.
Exactly. So the 1% rule is basically the mathematical guarantee that you can withstand that inevitable brutal streak and still wake up the next morning with the capital required to trade.
Which brings up a really fascinating mechanical problem, I think. Once a trader actually accepts that strict 1% boundary, the very next question is how to execute it, right? How do we translate that 1% abstract concept into exactly how many shares or contracts we're supposed to buy when a setup actually appears?
And that's where we move from theory into practice. It requires identifying 3 specific data points before a trade is ever placed. First, your current account equity, which establishes the base number.
Okay, got it.
Second, your risk percentage, which we've locked in at 1%, and that defines the maximum dollar loss. And the third data point is the stop loss distance.
Let's linger on that third point for a second, because the first two are static. If my account has $20,000 and my risk is 1%, my max loss is $200.
Correct.
But the stop loss distance, the text, defines this as the specific price gap between your entry point and the exact level where your trade thesis is proven technically wrong.
And that right there is the critical variable. You simply cannot determine how many shares or contracts to purchase until you know exactly where you will exit if the market moves against you.
You have to know where the exit door is before you walk in.
Exactly. This is the paradigm shift that elevates a trader. It forcibly moves the brain away from the greedy question of, how much money can I make on this trade?
Right.
And it forces you to ask the defensive question of, how much am I allowed to lose?
And the formula the text provides to bridge these concepts is honestly elegantly simple. It's your account balance multiplied by your risk percentage divided by your stop loss distance. And that calculation equals your exact position size.
Let's actually run the numbers on that $20,000 account you mentioned. 1% risk gives you a maximum dollar loss of $200. Now, assume your strategy dictates a $2 stop loss based on the technical structure of the chart you're analyzing.
Okay.
You take your $200 risk limit, you divide it by the $2 stop loss distance, and the output is exactly 100 shares.
And here is where the math creates a really interesting and honestly kind of counterintuitive dynamic. If I'm strictly adhering to this formula and the market suddenly becomes highly volatile,
Which happens all the time.
right, meaning I need a much wider stop loss just to give the trade breathing room and avoid getting chopped out by random noise, the formula forces my actual trade size to shrink.
It absolutely does, and that is a crucial self-regulating mechanism. A tighter stop loss inherently allows you to take a larger position size, while a wider stop loss forces a smaller position size.
Because of the division changes.
Right. But in both scenarios, the absolute total risk to your account equity remains firmly capped at $200. This entire concept is formally known as fixed fractional position sizing.
Fixed fractional position sizing, meaning you are always risking a fixed fraction, in this case 1%, of whatever your equity happens to be at that precise moment in time.
Yes, and that constant recalibration is what makes it vastly superior to how most struggling traders operate. The alternative is trading what's called a fixed lot.
Oh, like when someone just says, I always buy 100 shares.
Exactly. A trader might identify themselves as a 100-share trader or a 2-contract trader, and they just blindly purchase that fixed amount on every single setup, completely ignoring the current volatility of the asset or even the shifting size of their own account.
Which means their actual dollar risk is just fluctuating wildly from trade to trade. Like if they buy 100 shares with a $1 stop, they risk $100. If the next trade requires a $4 stop, they're suddenly risking $400 without even consciously making the decision to quadruple their list.
They're completely flying blind. The fixed fractional method solves this by acting as, essentially, an automatic transmission for your risk. It compounds beautifully during winning streaks.
Oh, because as the account grows, 1% is a bigger number.
Exactly. As your account equity grows from $20,000 to $25,000, your 1% risk naturally increases in pure dollar terms. It automatically allows you to trade larger sizes and capitalize on your momentum without ever changing your underlying risk profile. But the more vital function is how it protects you during a drawdown.
Right, because as your account balance decays during a losing streak, that 1% fraction represents a smaller and smaller actual dollar amount.
It functions as a mathematical parachute. It forcibly slows your rate of decay as you fall. The source material highlights a really staggering statistical reality here. Statistically, even a highly refined strategy will eventually run into a string of 10 or more consecutive losses just due to changing market conditions.
Yeah, the market shifts and suddenly your edge is out of phase.
Right. But if you utilize the fixed fractional 1% rule, a 10-trade losing streak results in a total account drawdown of approximately 9.5%.
Wait, I would have assumed 10%, like 1% times 10 trades.
It's actually less than 10, because after every single loss, your remaining account balance is slightly smaller, meaning your subsequent 1% risk is a slightly smaller dollar amount.
Oh, wow. It shrinks your exposure automatically.
It does. Now, compare that 9.5% drawdown to someone who trades based on gut feeling and risks 5 or 10% per trade. That exact same unavoidable 10-trade losing streak would result in a devastating 40 to 65% obliteration of their entire account.
And a 65% loss is catastrophic. I mean, the math required to dig out of a hole that deep is just brutal. If you lose 50% of your account, you don't need a 50% gain to get back to even. You need a 100% gain just to get back to where you started.
It's a massive hole.
The 1% rule keeps the financial and psychological impact of a losing streak entirely manageable. It lets you just stay in the chair long enough for the storm to pass.
And limiting that risk creates a really fascinating psychological paradox when you actually go to buy an asset, which leads to a massive distinction the text draws between notional value and risk capital.
Yes, I found this section incredibly illuminating. Because position sizing is entirely dictated by that stop-loss distance, it completely warps how you have to view the price tag of what you're buying. Let's talk about notional value first.
So notional value is simply the total face value of the assets you are controlling. Going back to our example, let's say you buy those 100 shares of the stock, and it is currently priced at $150 a share. The notional value of that open position is $15,000.
Which is a lot of money. If you're staring at a screen and watching a $15,000 position fluctuate tick by tick, I mean, it feels terrifying. Your heart rate spikes.
Right, but it only feels terrifying if you are blind to your actual risk capital. Because if your technical stop loss is resting at $145, you are only risking $5 for every share you hold. Multiply that $5 risk by your 100 shares, and your true risk capital is merely $500.
Let me offer an analogy to lock this concept in because the text makes it so clear. Imagine walking into a dealership and buying a $15,000 car. You write the check, you have the keys, but before you drive off the lot, the dealer hands you an ironclad, legally binding contract that guarantees you can drive the car back tomorrow morning and they will buy it back from you for exactly $14,500, no questions asked.
That's a great deal.
Right. Your real financial exposure in that scenario isn't $15,000. The car's notional value is $15,000, but your actual financial risk is just that $500 difference.
That perfectly illustrates the mechanism. When you have a hard stop loss in the market, you hold a similar guarantee, barring extreme overnight gaps, of course.
Sure.
And the text notes that traders routinely destroy their accounts because they misinterpret this relationship in two distinct ways. Sometimes they trade far too small because they're petrified of that $15,000 notional price tag, so they fail to maximize their mathematical edge.
And the other side of that coin is much more common and much more dangerous, honestly. They over-leverage their accounts completely. They look at a cheap penny stock, realize they can afford to load up on thousands and thousands of shares because the notional value is low, but they completely ignore the massive hidden risk capital just waiting to drain their account when the price drops a few cents.
Exactly. They conflate cheap notional value with low risk, which is a fatal error. And this required mapping of risk capital applies across every asset class you might touch. With equities, the math is a straightforward 1-to-1 ratio. Your risk amount divided by your stop distance in dollars. But when you move to Forex, you have to calculate risk based on pips.
Right, pips.
Yeah, so if a pip is worth $10 on a standard lot and your logical stop loss is 20 pips away, your underlying risk per lot is $200.
And if your personal 1% limit is only $100, the math dictates you can only trade half a lot. It scales perfectly. What about futures? Because we covered this extensively in our book, The Funded Micro. Because futures utilize leverage in a way that makes understanding risk capital absolutely vital.
Very true. Futures require you to account for the specific dollar value of each tick or point of movement. Let's take the micro E-mini S&P 500 contract as an example.
Yeah.
Each full point of movement in that contract is worth $5. So if your technical strategy requires a 10-point stop loss, that represents a $50 risk per individual contract.
Right.
Therefore, if your strict 1% risk limit is $150, the math objectively dictates that you are permitted to trade exactly 3 micro contracts. No more, no less.
It just completely removes all the guesswork. But having this elegant mathematical formula introduces a totally new problem. I know my risk capital, and I know how to calculate my position size. But I can't just pick a random stop-loss distance out of thin air to make my math output a nice round number of shares. Right? Like, where do we actually draw that line in the sand?
That is where the rigid math must meet the fluid reality of the market. Your stop-loss must be placed based on objective technical levels on the chart, not your personal financial desires.
So it's about what the chart is doing, not my wallet.
Exactly. You're looking for a logical zone, perhaps just below a recent swing low, or just outside the boundaries of an established price channel, basically a place where your entire foundational reason for entering the trade is proven demonstrably invalid.
So I can't just look at a chart and say, well, my max risk limit is $100, so I'm just going to place my stop loss 20 cents away from my entry so I can afford to buy 500 shares.
If you try to force the market to adhere to your arbitrary math, the market will punish you with normal noise. Asset prices fluctuate constantly. They need room to breathe.
They vibrate.
Right. If you place a stop loss artificially tight just to manipulate the position sizing formula into granting you a larger position, you are practically guaranteeing a loss. The market will simply vibrate, trigger your tight stop, and then likely proceed in your originally anticipated direction without you on board.
Oh, that is the most frustrating feeling in the world. So the technical level of the chart always has to dictate the math. You never let the math dictate the technical level. You find the logical stop first, and then, and only then, do you adjust your position size to fit the 1% constraint.
Always.
Yeah.
But this introduces a scenario that really tests a trader's discipline. What happens when you find a phenomenal technical setup? You identified the absolute perfect logical place for your stop loss. But that stop loss is so far away from your entry price that your mathematical formula says you cannot even afford to buy a single share or a single micro contract without violating your 1% rule.
That's tough. You just have to walk away.
You abandon the trade entirely. True professionalism in this industry is defined by the discipline to aggressively reject trades that do not perfectly align with your risk parameters.
You are protecting the inventory of your shoe store.
Exactly.
And there is another crucial layer of protection the text introduces regarding when to walk away, which is the concept of correlated risk. Because everything we've discussed so far applies to individual, isolated trades, but a trader's total market exposure at any given moment is what really determines their survival during a crisis.
Absolutely. Imagine scanning the market and finding 5 beautiful technical setups. They all have logical stops and they all perfectly fit your 1% rule. You execute all 5 trades. However, all 5 of those setups happen to be tech stocks in the exact same subsector.
Oh, I see where this is going.
Right. If a piece of devastating macroeconomic news hits the tech sector an hour later, all 5 of those stocks are going to gap down and plummet simultaneously.
Wow. So in that scenario, you aren't actually taking 5 independent, uncorrelated 1% risks. You're taking a massive, concentrated 5% risk on a single sector-wide event. You've basically circumvented your own mathematical shield.
You are highly correlated, and that vulnerability is how accounts are wiped out during black swan events. To maintain true capital preservation, the text advises capping your total open risk across all active positions to a hard ceiling, often 5 or 6% total. This prevents a sudden, single market-wide shock from bypassing your individual stops and destroying a massive chunk of your portfolio in minutes.
It is all about building overlapping fail-safes. And the source material strongly suggests utilizing a position sizing calculator or like a pre-formatted spreadsheet before taking every single trade to enforce these fail-safes mechanically. You literally input your account balance, your entry price, and your technical stop-loss price.
And you do not allow your finger to click the buy button until that external calculator confirms your exact unit size. Relying on an external tool removes the heat of the moment. Over time, adopting this highly mechanical approach fundamentally rewires how you interact with the market.
Which actually brings us to the final and perhaps the most profound implication of our deep dive today, the psychological endgame. Because when a trader commits to implementing all this math, when they place logical technical stops, when they calculate fractional sizing, when they limit correlated exposure, it genuinely alters their brain chemistry while they are staring at the screens.
The psychological stability it provides is immense. When backed by absolute mathematical certainty that no single trade can meaningfully damage your financial standing, the fear and panic that drive terrible decision-making simply evaporate.
It is the ultimate cure for analysis paralysis. I've seen so many people freeze at the desk, they put in the screen time, they do the technical homework, they identify the perfect setup playing out right in front of them, but they physically cannot pull the trigger.
They just lock up.
Yeah. Their hand hovers over the mouse, but the stakes just feel too high.
And the stakes only feel high because they haven't quantified the risk capital. In their mind, they're staring at that $15,000 notional value instead of the $500 defined risk. By keeping your risk mechanically small, consistent, and mathematically sound, you strip the emotional weight from the action. You stop viewing each individual trade as a life-or-death financial event.
You stop staring at your fluctuating account balance and sweating every minor tick of the chart.
Exactly. You transition into viewing each trade merely as a single data point in a very large statistical series. A stopped-out trade ceases to be a personal failure. It becomes just the anticipated cost of doing business. It is a tiny, calculated expense paid to gather data on your edge. That fundamental shift in perspective is the absolute hallmark of a professional mindset. It liberates you to focus entirely on the quality and precision of your execution, rather than riding the emotional roller coaster of your daily account balance.
So, to synthesize this entire framework for you, the biggest takeaway from our deep dive today is this. Professional market mechanics aren't about maximizing how much money you can ruthlessly squeeze out of a single glowing opportunity. They are about systematically, mathematically controlling exactly how much you are allowed to lose, ensuring you always have the inventory required to stay in the game and let the math work in your favor.
It is the ultimate defensive strategy designed entirely to facilitate long-term offensive success.
It really is, and I want to leave you with a final provocative thought to mull over. We've just spent this time establishing that achieving success in the chaotic, unpredictable financial markets relies entirely on treating each loss as a tiny, unemotional data point in a much larger series. What if we took that exact same 1% risk mindset and applied it to our everyday life decisions?
Oh, that's interesting.
Right. If you could reframe your own personal failures, rejections, and fears as just managed 1% data points in the larger series of your life, what would you finally have the courage to attempt?
That is a deeply powerful question to consider.
It certainly is. Thank you so much for joining us on this deep dive. Be sure to visit www.franksreport.com. Check out the book, The Funded Micro, Modern Future Strategies for the Prop Firm Era, and follow the show wherever you prefer to listen. We will catch you next time.